So this video is inspired by a really great question that came in from an existing client who is a new client to us within the last 6 months, who is a little bit unfamiliar and doesn't have maybe this same experience with risk parity and how it interacts with markets, over several years as many of our long-term clients. But this question is something that gets often asked. Is they'll look at a portfolio statement and they see, especially when the market is on a bit of a tear, like it has, post-election, there's a little bit of a bump. We had a couple of great news from vaccines and potential vaccines for COVID. That spurred a rise in equity markets. But conversely, because of the very nature of non-correlated assets, it drove some of those non-correlated assets lower, namely long-term US Treasuries. And what's interesting is almost always there's that negative effect where, well, how am I losing money when the market's going up? But remember, this is by design. The only way that you will have all of your assets increase when markets are performing well is if you are over-concentrated and too heavily weighted into equities. Now that might pay dividends and do well in the short term. However, when you run into volatility, and it happens every single year, and when you run into extreme market volatility, when you have recessionary periods which happen up to 1 to 2 times per decade, you can find yourself on the wrong side of investment performance by a mile. And in March, those that were heavily correlated to the market would have been down 30–40%. And so when it works well and it protects assets, they look like rock stars, and that being the non-correlated assets. When the market is surging ahead and it looks like there's no end in sight, they are going to lag as if you're running with a parachute on. But that is by design. It is the only way to ensure that you have a fully diversified, non-correlated portfolio. So don't be alarmed when you see some of those assets underperform when the market does well, because it's right around the corner where volatility will step in, and you'll be glad that you have those assets.